मका सुपने की दुनिया ते बाहर आ गई हो तो काम धंधा भी देखना चाल का है।
चल
चल ये रवि की आग लगी रे। हट जा बाबा, हट जा।
ना पारा
हो जाएगी।
बेकार
के पड़ गया तेरे में लड्डे। मका सुपने की दुनिया से बाहर आ गई हो तो काम धंधा भी देखना चाल का है। चल
हाय वे अगले गले कमीदियां करी मानू मैं की चटना है फैटी दिया जिन्ना नु अगले गले कमीदियां करी मानू मैं की चटना है फैटी दिया जिन्ना नु मेरे नाल रिलेशन ब्रेक करके मेरे नाल रिलेशन ब्रेक करके पाना माही तू जब लेगा तू ता तेरी अंजराबा भी नहीं लब सकदा वे मैं तो सोनी किथों लब लेगा ओ तू ता तेरी अंजराबा भी नहीं लब सकदा वे मैं तो सोनी किथों लब लेगा शक्ल तेरी काका एनी अकड़ी नी तेनू सूट करदी शुक्र मनावे पुत्त तेरे गहनों वे गुड़ी मिली सारा अली खान वर्गी शुक्र मनावे पुत्त तेरे गहनों वे गुड़ी मिली सारा अली खान वर्गी मोने वाले आ मैं लत्ता तोड़ू तेरिया मोने वाले आ मैं लत्ता तोड़ू तेरिया जे मैनू छड़ने दा नाम लेगा तू ता तेरी अंजराबा भी नहीं लब सकदा वे मैं तो सोनी किथों लब लेगा तू ता तेरी अंजराबा भी नहीं चांदी 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 वे मैं ही तेन कट्टी जानी आ वे मैं ही तेन कट्टी जानी आ हुंदी होर कोई कदों दी छड्ड जांदी मैं ही तेन कट्टी जानी आ हुंदी होर कोई कदों दी छड्ड जांदी मैं थकदी नी जट्टा तैनू जानू जानू कहंदी तू भी रखिया ता कर थोड़ा मान वे तेरे ही नी नक थल्ले आउंदी सोहणिया मैं तेरी फैमिली सवारे मैथों जान वे तेरे ही नी नक थल्ले आउंदी सोहणिया मैं तेरी फैमिली सवारे मैथों जान वे आउंदियां ने बहुत गप्पां याद तेरियां आउंदियां ने बहुत गप्पां याद तेरियां कि चाबी बेड ते पड़ाया करेंगा तू ता तेरी अंजराबा भी नहीं लब सकदा वे मैथों सोहणी किथों लब लेगा ओ तू ता तेरी अंजराबा भी नहीं लब सकदा वे मैथों सोहणी किथों लब लेगा
number, a dampening of consumer inflation expectations depending on which survey you look at, and unfinished business in the labor market that they see. So the problem is those more in the inflation cautious or inflation warning camp also feel they have a lot of evidence for their cause. So these releases, and we have U.S. PPI coming Tuesday morning in Washington, have become sort of Rorschach tests where everyone sees what they want to see. And through all this, markets have actually largely played along with the Fed, as we saw with the rally in treasuries after the very high U.S. CPI print last week. So the expectations for something different from the Fed, therefore, are a bit low but notable. Most economists in our Bloomberg survey expect to see them shift that all-important dot plot just a little bit, signal that rate hikes could begin in 2023 rather than 2024, as the Fed has shown in its forecast. And a plurality of them also see the Fed hinting at a more solid tapering timeline for monthly asset purchases. Some sometime shortly after their Jackson Hole gathering in late August, so don't schedule your vacations yet. And there will be plenty to watch for in the press conference this week around some of these sub-debates. We're looking for, perhaps comment around the housing sector, which our colleagues in Bloomberg Economics point out in a study this week is looking quite frothy across a number of countries.
Michelle, great to have you with us. Look, I said at the start of the show, I mean, you know your career's taken a new trajectory when Anne-Marie Horden's talking about lumber prices per square thousand board foot. It's a big pivot for her. But on a more serious note, the Burr voices really are mounting, aren't they, Michelle? And I think this is the interesting thing, because you get JP Morgan saying, look, we're underpricing the rate hikes out there. We've pivoted to from extremely cheap, i.e. 1.75%, to extremely rich. We had a guest with us yesterday, Martin Malone, and he said, actually, the repricing in the bond market is to do with a supply shock, because Janet Yellen's Fed, or her Treasury bank account, has plummeted. So there's a supply shock. That's the repricing in the bond market. Because you get JP Morgan.
Yeah, I mean, there's certainly a heated side debate on what's going on in the bond market and why it's rallied. When you see such a high U.S. CPI print, I mean, I think that will also be a subject for debate. Of course, liquidity, different quirks in the bond market are certainly becoming a bigger issue. I would point to, Roberto Curley, a good former Fed official who's been chasing this and running some numbers around why that might be the case. He's more in the camp of, this is all bonds kind of reacting to playing along with the Fed and being more on team transitory than maybe they believe or lead people to believe day to day with their inflation warnings. So that's certainly something that's kind of throwing a wrench in, easy data analysis these days. So I sympathize with Anne-Marie looking at everything we can and maybe things that we didn't used to try to figure this out. I mean, I think the other thing I would keep an eye on, certainly the commodities trends that you mentioned, not just for lumber, but for all the materials that we had seen spike over the past couple months and really fueled this debate as well. And fiscal stimulus. It's going to remain a hot button issue. So with any further progress on the Biden administration's infrastructure plans, we'll have to chase, whether or not this is going to have an impact as well and perhaps change the debate for everyone.
Indeed, those fiscal plans, Michelle, are going to be what could upend that bond market. Michelle Jamrisko, thank you very much. All the nuances, the twists and the turn in the bond market at the top of the show. Simone Foxman has your first word news. She's in Doha.
Thanks, Manus. British Prime Minister Boris Johnson announced a month-long delay in lifting England's virus curbs as concerns over a rapid rise in COVID-19 cases persist. Of particular concern is the increase in cases across the country of the highly contagious Delta variant. The government also said it will not extend financial support for businesses further, even despite the delay. China's rising military ambitions present NATO with challenges that must be addressed, the alliance said, marking a shift in its stance that could kindle a confrontation with Beijing. Secretary General Jens Stoltenberg heralded the speed at which the group stepped up to meet the threats. In response, China warned that it won't sit back in the face of any challenges. Microsoft President Brad Smith criticized secret data subpoenas sent by the U.S. government to cloud providers like his company and Apple. He said gag orders on requests for personal information undermine freedoms and are hurting U.S. technology companies in Europe. Smith spoke exclusively with Bloomberg's Emily Chang.
What we do know is clear. The DOJ used its authority in the Trump administration to pursue an investigation of these reporters and these people connected to Congress. Rather than serving a warrant on the individuals themselves, they went to the tech companies that had the emails or text messages and the like. They went to Apple, they went to Google, they went to Microsoft, and they not only served the warrant, they imposed gag orders, a non-disclosure order. And I think it raises very squarely just a very critical issue about the way this law enforcement process should work.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anne-Marie Manus.
Simone, thanks so much. Simone Foxman. Just ahead, how does an oil major become a renewables company? We'll talk about the success and challenges of the energy transition with Anders Opedal, Equinor CEO. Don't miss that interview next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
It's Daybreak Europe. I'm Manus Cranny in Dubai. I'm Marie Horton alongside me at London HQ. The race to cut reliance on fossil fuels and one oil company is shining. Equinor posted $2.6 billion in earnings in the first quarter, with almost half of that coming from renewable energy. The Norwegian state-owned company plans to go further. It's targeting a 50% target of investment in renewables by 2030. Setting the agenda, it is the CEO of Equinor, Anders Opedal. He joins Anne-Marie and I. Anders, thank you so much for joining Anne-Marie and I. Lots of headlines to get through, but let's just jump off with what the shareholders are getting in the first instance: a share buyback and a cash dividend of $1.8 billion. Is that built on a very bullish forward outlook?
Well, what we are presenting today is a strategy where we are increasing our investment in renewables, but at the same time also increasing our cash flow and returns. That enable us to give an attractive capital distribution to our shareholders. And we are committed to provide both attractive capital distribution to the energy transition while also investing. So this capital distribution we are announcing today is an increase in 20% in the cash dividend from 15 cents to 18 cents per share. And we will grow this in line with the long-term underlying earnings. In addition to this, we are announcing our annual share buyback program from 2022, and this is a part of the total capital distribution. We're also starting this share buyback in now after the second quarter with a $600 million program. We are able to do so based on strong returns from our oil and gas business, and also that we have demonstrated that we can create a lot of value in the renewables.
Yeah, a lot of this has to do with your return, though, the capital you're getting from the oil and gas production. Anders, how do you do both? How do you become a green company while at the same time making sure you can have these dividends, have buybacks, and continue to produce oil and gas? It's a very tight line to walk.
Yeah, it is, but we have a very attractive oil and gas portfolio. We see that we are able to invest in increased oil recovery, particularly on the Norwegian continental shelf. This has low break-even, even below $25 per barrel. The payback time is less than 1.5 years. And also we're producing this with very low emission. This combination of the attractiveness in the oil and gas, using the cash from this industry over to investment in renewables, and more than 50% investment in renewables below after 2030. That has enabled us to do the energy transition while growing cash flow and provide attractive return to our shareholders. But it's really based on all the fantastic good work our employees are doing. We have really good people in the oil and gas business, and we've been able to take that competence and move it over to our renewables units and also to the carbon capture and hydrogen business.
Look, Anders, the agenda that you've set this morning is about extending your oil and gas production through to 2030, yet you set the zero carbon target. I'm just wondering, we've had a slew of backlash against big oil at Exxon and Shell. Are you moving fast enough in the sightline of the activist investors? Do you run the risk that you're going to get an activist investor on board? Are these ambitious enough plans?
Well, we think they are ambitious. We are committed to our net zero ambition in 2050, and we have been looking into what can we do to achieve the net zero ambition for us, and what can we provide and help the society with. And we think we are able to do this by producing oil and gas with the lowest emission possible. Will be producing oil and gas with only 1/3 of the emission compared to our competitors. We are investing in offshore wind, particular, where we have demonstrated where we have a competitive advantage. And the world will need more carbon capture and storage and clean hydrogen. And we also have a lot of that competence. We are actually now already executing the world's first projects where we will take third-party volumes of CO2 from Europe and safely store it on the Norwegian continental shelf.
Anders, what about splitting up the company? Have you ever thought to one being fossil fuel and one a green company?
Well, we think that there is a lot of synergies between the parent company and also the renewable business, particularly in project execution, taking that capabilities from oil and gas and see what we have done with the Johan Sverdrup field in terms of project capabilities. We're also using our extensive offshore competence to ensure that when we develop the offshore wind, we're taking all the competence we have about corrosion, fatigues, and so on to avoid mistakes when we are developing the offshore wind business. And we're doing the same, the competence from the reservoirs, from also the hydrogen and CCS. And for renewables, there also we have a strong trading unit so in parts of our business. To have this connected actually make us to do more, faster, and better.
We're in the closing minutes. Time is always ticks down, Anders. You're saved by the clock. But the IEA has called for no further discoveries, immediate halt to new oil and gas developments, yet they call on the petrostates to open the taps. Prince Abdulaziz bin Salman says the IEA is in la-la land when it comes to new discoveries. Do you agree? Is the IEA in la-la land with their call for no further a halt to new oil and gas development?
I think that is a very important report. It really demonstrates the challenges we have ahead of us. The world needs more energy, but it needs more clean energy, and it needs carbon capture and storage and hydrogen at scale. What we are presenting to that is actually to do more of these things while we are producing oil and gas that the world needs with as low emissions as possible.
Anders, thank you so much for joining us. An exclusive interview with the Equinor President and CEO, Anders Opedal. Now, just ahead of the program, the Viva Tech Conference returns in Paris. CEOs, innovators, and startup founders will be discussing the future of tech. And we're going to be speaking to Maurice Levy, Viva Tech founder and chairman of Publicis. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax
to help you out with your trading
in the
plans
world
for the
private sector for all of this. It's going to have to be a public-private partnership.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Challenges. The UK is set to announce the broad terms of a free trade deal with Australia on Tuesday in the country's post-Brexit push to expand commerce beyond the European. Bloomberg sources say the deal is expected to cut tariffs on products like scotch, clothing, and cars. It's also due to reduce levies on agricultural products, which has drawn backlash from Britain's farming sector. JP Morgan's expecting a 38% trading revenue decline compared to a year ago, more than previously expected. It's a sign the pandemic-era trading boom could be drawing to a close. At a virtual conference, CEO Jamie Dimon said revenue would now be just above $6 billion.
Last quarter is exceptional. This quarter is what I call more normal, where you can plug in your model and make it really simple. It's like something a little bit north of $6 billion. Which is still pretty good, by the way, and probably better than we told you last time. But last time we said more like 2019. I forget what that number was, but plug in a number a little bit north of 6.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anne-Marie Manis.
Simone, thank you very much. It's one of Europe's leading tech conferences, VivaTech. It comes back to Paris, hybrid style. Starting from tomorrow, the speakers include Facebook's Mark Zuckerberg, Apple's Tim Cook, to discuss what tech can do for society and for the planet. Maurice Levy, friend of the show, and Bloomberg, is part of VivaTech, the founder and the Publicis chairman. Maurice, bonjour, welcome. Good to see you. Good to see you bringing the hybrid model to life. It's probably with us forever. Anne-Marie and I were considering how to tackle this challenge. You've got Facebook, you've got Apple. Our question that we coalesced on, tech has a huge responsibility, perhaps, out of this pandemic, more so than ever before. What should tech be doing at this conference to absolutely garner our trust in our data with them? Good morning.
Good morning. Thank you for having me. I'm extremely pleased to be with you. VivaTech is a very special year, an edition which will be, as you said, hybrid, with a lot of technology which will be at work, as well as a lot of innovation which will be shown, and great speakers. To your question, what technology can do, we have seen already how technology has helped business to do not stop during the pandemic, because as everyone, we have been able to work remotely thanks to Zoom, Teams, and other tools. And tomorrow, we will see new ways of working, and technology will be part of our daily life even more than it has been today. So the discussion with Tim Cook, with Mark Zuckerberg, or with Eric Yuan, as you have mentioned, but a few others also in the daily life. We'll have also the commissioner from Europe, Thierry Breton, or we'll have also Dan Schulman regarding PayPal. All these will change our life, and there are a lot of things which are going to happen. And this is what we try to get at VivaTech, the truth of what will happen tomorrow. Yes.
Maurice, coming out of the pandemic, there's obviously going to be changes for tech, but what about the outlook for the advertising space? What's the most radical shifts?
The first radical shift is something which has already happened when you see that digital represent today 58% of media spend, which is enormous. And the key question which will happen tomorrow is how are we going to deal with privacy and with the fact that we will be in a cookie-less world. From the publicity standpoint, we have already developed a few tools which will help our client deal with those issues. So there are some strong and a very important discussion to have, and particularly regarding the fact that some platforms have a market share which is starting to become a bit of a problem, unless if there is a fair market.
Maurice?
Yes?
You're living in a technology hybrid world. I'm going to give you a request, sir. Please stay with us. Do not hang up the Zoom. We're going to try and continue the conversation with the Publicis chairman. There's plenty more ahead on a day that sees the English reopening delayed.
Good morning from Bloomberg's European headquarters at 6:30 a.m. in the city of London. I'm Anne-Marie Horder with Manus Crowley live from Dubai. This is Daybreak Europe, and here's what you need to know. England delays its reopening as infections mount. The Delta variant now accounts for 90% of UK cases. President Biden's visit to Europe continues with an EU-US summit. This as NATO warns of China's military power. And Jamie Dimon says the trading boom could be coming to an end, signaling a big drop in trading revenue for JP Morgan. Manus, good morning. A lot of politics taking place across the continent with President Joe Biden here. The UK Freedom Day, as they're calling it here, being pushed off another 4 weeks. And, of course, it's the start of the FOMC meeting. So a lot going on this week.
Absolutely. Are we tired and emotional? Not you and I. I'm talking about stocks. What if there's a hawkish tilt in... We're never tired and emotional on this show, are we? If there's a hawkish tilt from the Fed, could it unseat the stocks? Let's have a look at it. S&P 500, again, kissing records. European stocks up for the 7th session in a row. Anne-Marie, we're looking at the stocks 50 here, but of course, it's the stock 600. A blazing trail ahead of U.S. equities for the first time in a number of years. 10-year bonds remain anchored at 148. But are inflation expectations, are they spiraling into the unmoored zone? That is the question. KKR say to us, Mr. Levy there says, no, it's not. KKR say we're not going to run out of control on these markets. And the lira got a little bit heavy yesterday on the back of the Biden Erdogan meeting, because Erdogan said we're sticking to our S-400 plan at the moment, and that irked the markets a little bit because they need to see those sanctions removed. Now, a man who's seen a number of cycles and dealt with some huge campaigns and merger and acquisition challenges, Maurice Levy, VivaTech founder and Publicis chairman. Maurice, great to have you with us. Thank you so much for staying with Anne-Marie and I. The very essence of tech is about the risk of regulation. I want to get a sense from you. Are you more concerned about regulation rising in the US, Europe, or China in regards to the tech future?
I think that we need more regulation than what we have today. The last 20 years has helped internet to develop in a huge way, and at the same time with a level of disorder which has helped some very large companies to become dominant in their market. Some regulation is absolutely necessary. We should not have an excess of regulation, which is one of the sin of the Europeans, but we should have a good balance and something which is protective for all the players. And today, we must recognize that the market is unbalanced, and some positive regulation will have a positive effect for the market.
Coming out of the pandemic, Maurice, I'm going to stay with the geographical zones Matt has pointed out to, but coming out of the pandemic, what do you see in terms of advertising sales in Europe, United States, and Asia, and what does that mean in terms of these regions' recovery?
Asia, I will start with Asia. Asia has had last year less issues than the rest of the world. And therefore, when you see the recovery of Asia in nowadays, it is more reasonable, and it is at a level which is quite, I would say, the lowest of the whole world. If you look at the US, it is a V shape, and you have a very strong return to investment. We see the same pattern with a small delay in Europe happening. So the economy is starting to boom, and I'm saying booming because it's very strong. There is a very strong appetite for the consumer to consume, to shop, to go to the theaters, to travel, to really have a normal life. It is a little bit like if they have been in a kind of desert for a long while, and they are getting out of that desert and they want to have everything. So we have a kind of flurry of consumption in nowadays.
Yes, we're doing it for the Instagram, Maurice. We've seen that written by one or two economists. We're doing it for the gram. Maurice, I remember many years ago we looked at your deal, Omnicom Publicis. It floundered on culture. We understand Havas has made an approach. Have you made up your mind? Can you see Havas and Publicis ever joining? Are you an absolute no?
I think this is something which is happening on a regular basis. We call this in French a marronnier. A marronnier is what the journalists are bringing on a regular basis, almost every year at the time of the fall, and they are bringing some ideas which have very little chance to succeed, simply because it would be a nice headline to bring companies together. We have huge respect for Havas and for Vivendi and what they have achieved so far. We believe that it's a great company. However, we have both a different destiny, and I think it's very good for France to have two champions.
Right, and when they spurned that approach, they certainly want to extend your role in the Publicis chairmanship to do that. Maurice Levy, thank you so much for sticking with us today, and good luck with the Viva Tech conference. Publicis chairman and Viva Tech founder, thank you so much for joining us. Now, it's one of our top stories today. England's Freedom Day, as some have been calling it, has been delayed. And as this is as expected, Boris Johnson last night announced he was pushing back lifting virus curbs by a month. And this is amid growing concerns over a rapid rise in COVID cases as the highly contagious Delta variant spreads. But the Prime Minister reassured weary Britons that an end is in sight.
On the evidence that I can see right now, I'm confident that we will not need more than 4 weeks, and we won't need to go beyond July the 19th. It's unmistakably clear the vaccines are working, and the sheer scale of the vaccine rollout has made our position incomparably better than in previous waves.
So potentially that is the final extension of the lift-off or removing those restrictions. UK economy reporter Lizzie Burden joins us now. Lizzie, thanks so much for joining us. So this extension is really devastating for certain sectors. Anecdotally, I know some private members clubs in Mayfair are planning to have huge blowout parties on June 21st. But what does it really mean for the economy in general?
Yeah, so last night's announcement of a 4-week delay will come as a big blow for certain parts of the economy. Boris Johnson said it was time to ease off the accelerator because of the rapid spread of the Delta variant. But the main consequence for businesses is the degree of contact people will be allowed to have. It'll severely curtail earnings, especially in hospitality during what's usually peak season for the industry. And yet, despite the announcement of what had been billed as Freedom Day, as you say, the government's dashed hopes of support for businesses being continued. The furlough scheme, for example, will still be tapered as planned, and that's despite the warnings of leaders in the hospitality industry that a delay would put hundreds of thousands of jobs at risk. On the other hand, we have been hearing reports of labour shortages in various sectors in recent weeks, so it may be that the government's accepting that and trying to allow the economy to restructure, not to mention trying to save on the ballooning cost of furlough. So this could be the nail in the coffin for lots of sectors, businesses in lots of sectors, hospitality, the arts, entertainment, recreation. But economists had been expecting a delay for 2 to 4 weeks anyway. And we've seen confidence and mobility recovering despite the current restrictions. So overall, the economic impact could be quite limited.
Lizzie, thanks. Yeah, and if you just track some of the output across the news networks yesterday, there was a real sense of angst at the chopping and changing in government policy, and would businesses survive? Lizzie, thank you so much for joining us with the very latest on Freedom Day in the UK. Now, the main market driver today, it's all about the Fed. It's the latest gathering. Some say it could be the most important gathering of all for signals on the timeline for paring down emergency stimulus. Our guest, very patient this morning, is Ashish Marwah, ADS Investment Solutions CIO. Ashish, thank you so much for being with us. The narrative is building in the markets that we could be in for a hawkish tilt. What would a hawkish tilt look like, aka dots, or sound like, aka rhetoric from Powell?
I think the expectations of a hawkish tilt are a bit overdone. I don't think the Fed is in any mood to change its policy stance, which is they'll sit back and wait for inflation, the short-term inflation aspects to go away, and for unemployment to start inching back to where it was before the pandemic. So I think the expectations of a hawkish tilt are a bit overdone. However, what the Fed has shown over the last few weeks is that they are are willing to roll back some of their emergency programs, and they cut back on their corporate purchase program, and now they're reversing it. And the market hasn't really worried about it. And I think some action on mortgages may come where they should stop buying mortgage-backed securities, but they may replace it with more treasury purchases. So this feeling around this meeting being a hawkish one, I don't think the Fed wants it. I don't think the market wants it.
Okay, but the economy is recovering well. The financial conditions, FCI, are very loose. Don't they have to make at least a nod, Ashish, to that? Doesn't Powell have to make a nod to what is going on in terms of the recovery in the United States?
Yes, and I think they have been making that when they have started talking about tapering. So I think that's where they would like to leave it at, and not. If you think about what the Fed's aim is right now, is to not create surprises in the market while we are still in a fairly restrictive environment caused by this pandemic. We are at the tail end of it, but we still have the impact of restrictions, and we still have the impact of incentives that have been given to the public to stick to those restrictions. So we are still not in a very normal environment for Fed policy to change or to go back to somewhat of normal anyway. So I think the Fed would like this meeting to be a non-event while still doing things to pull back on their emergency support that they have given. As I said, they have taken back some of that emergency support from corporate bonds, and now they probably will take it back from mortgages. The housing market is doing already very well. It's able to self-finance itself, but not more than that.
Ashish, I don't know how you feel and the team at ADS, but there's a sense of exhaustion in the daily grind about the machinations of transitory, tightening, taper. There's an exhaustion in the debate. Is there a risk that when it arrives, perhaps it's most underpriced in the equity market relative to the bond market?
We've seen the bond market too pricing out some of the inflation concerns. Again, we have no reason to conclude that the Fed is wrong on its assessment of inflation pressures being transitory at the moment. However, the Fed keeps stressing the fact that it's transitory and that prevents a more stronger supply side response. But I think we are still in the middle of those restrictions that are causing this transitory spike in inflation, and there is a risk that this will be more than transitory, but we need to be in a much more normal environment to be able to judge that. And the Fed is not going to preempt that normal environment and make that judgment. And neither is the bond market, which tried to, has come to a realization that maybe we did it too much, and now the bond market has pulled back. Yields are lower from where they were about a month and a half ago. So I am less worried about the equity market getting worried about inflation just yet until they see an end to these restrictions around the pandemic.
Ashish, to Manas's point, it seems like financial markets are just obsessed with this idea of it's transitory, going to be something more entrenched when it comes to inflation. Are we missing the bigger story when it comes to employment? The International Labor Organization said globally 75 million this year. That shortfall does not stop next year, 23 million unemployed next year. Where is the employment narrative going to be when the Fed delivers this statement this week?
That is exactly my point. I think we are overdoing a bit on the fact that inflation is becoming entrenched. These are extraordinary times. They called for a suspension of market economics by an intervention from the government in the economy by providing stimulus, by imposing restrictions, and that caused a bit of a lopsided economy in favor of goods relative to services. Now, as those restrictions end, we would see the service economy take over. We would see job creation start to go up, but we need governments to now accept the fact that their vaccination levels are high enough for our economy to get back to its normal stage, and then let job creation take on its normal role. We're not there yet, and I think that will take some time. That's why any expectations of rate rises or Fed pulling back its support are a bit premature.
Okay, Ashish, let's see what the Fed has to say or do in terms of indications tonight? Ashish Mawar, ADS Investment Solutions, our guest host this morning. Coming up in the show, NATO talks tough on China. We're live to Brussels. This is Bloomberg.
Wednesday, the Fed decides. Will the Fed react to accelerating inflation concerns? Are members eyeing an earlier rate increase? Coverage begins at 1:30 p.m. on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
It's Daybreak Europe with Manus Graney in Dubai. I'm Marie Horton alongside me in London. President Biden is still in Europe, set for his first summit with the EU today. Yesterday saw the meeting of NATO, with the alliance warning of China's growing military power. Joining us now from Brussels is our correspondent, Mario Tadeo. Mario, if we look at the NATO meeting yesterday, China went to the top of the agenda, but they all got a side opportunity to deliver their message on Russia. Angela Merkel didn't go on side on the anti-China beat, did she?
Well, no, she didn't. And, you know, Manus, this is a very good point, because to some extent, the Europeans do oftentimes get accused of being too soft on China, precisely because they have big economic interests when you look at the Chinese economy and the interdependencies with the European economy. Now, what they say, however, is that this is much more nuanced than that. The Europeans believe NATO and the G7, for that matter, should not be against a country. They should be for something. They need to come up with ideas to put on paper and execute. You know, when Angela Merkel speaks of the Silk and Belt Road, she says the Chinese have been very good with infrastructure. Then that means the U.S. and the European Union should come up with a similar plan. So the point from the Europeans is very much about coming up with ideas that could counter China, but not go fully against China. And that was reflected in that statement yesterday in NATO, when all of the allies agreed that China is an economic power, could also become a big military power, and to some extent that could be a threat to global security and the international rules-based system. Manners.
Maria, also ahead of the U.S.-EU summit, the Financial Times reporting that the two sides are set to end the 17-year Boeing-Airbus dispute. Now, this could save billions in tariffs. What do we know? Is that going to be the big headline coming out of today's meeting?
Well, Yes, Anne-Marie, look, this deal looks incredibly likely, and it's probably going to be announced today. This is a 17-year dispute. As you know, one side accuses the other one of helping their airlines and their aviation company, that this would give them an unfair competitive edge and that this is ultimately unfair competition. Now, those tariffs could have done a lot of damage for both European products but also American products. Today, the expectation is that President Biden and the Commission will agree to suspend that tariff war, and they would come up with a compromise that means they would have to implement a limit to state subsidies going into those two companies. So that issue would be resolved. To some extent, Anne-Marie, it also makes sense. You know, those tariffs have been suspended for 3 months now, and this would signal now a real return to a normal relationship between the two sides.
All right, thanks so much to Maria Teo, who'll be at that US-EU meeting. Just ahead of the program, a warning from Jamie Dimon, and this comes when it comes to trading revenue. The details next. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Very good morning to you. This is Daybreak Europe. I'm Emery Hordern in London with Manus Cranney in Dubai. Now, JP Morgan CEO Jamie Dimon is out with a warning for Wall Street. The pandemic-era trading boom may be drawing to a close. Joining us to discuss is Danny Berger. Danny, did this warning from Dimon, he said just a little bit north of $6 billion. Is this a surprise for Wall Street watchers?
Well, clearly it was a surprise to some because we did see shares fall around 2%. And it wasn't just JP Morgan, it was really all banking shares. So that north of $6 billion you cited, the estimate had been around 6.5. So, you know, it's definitely worse than what was expected. But really, we knew that executives had been warning about this for basically the past year, saying that this boom because of volatility in trading revenue isn't going to last. So this is more of a case of Wall Street really just sort of fine-tuning their model for what earnings are going to look like rather than some huge shocker that this trading revenue isn't going to last. We also heard from James Gorman of Morgan Stanley giving a similar warning as well during this virtual conference that Jamie Dimon spoke at.
Yeah, these are, I mean, literally, Jamie Dimon is the king of guiding expectations. So when we arrive on those results day, it's not pandemonium by everybody. They go, oh, the bond desk didn't have another blowout quarter. Now, Deutsche Bank, if you're looking for strategy, this is what I'd call a medium-term investing strategy. They've had an absolute belter from a trade done in 2016. What's the trade? What did they win?
So it's on an Israeli shipping company. It was a 35-year-old trader who basically made bets on distressed debt from this company. And Manus, it's really fascinating because as we see the turmoil in supply chains, you're going to get the winners and losers from that. Well, Deutsche Bank, certainly a winner here. This bet was considered very risky at the time. Shipping rates were really low because of tensions between China and the U.S. And this trader had a hard time having anyone join Deutsche Bank in this bet. Well, it's paying off now. Deutsche Bank is expected to earn about $1 billion from this trade on this Israeli shipping company because shipping rates have gotten so high. This is scoop from our colleagues on the European banking team. Just a really remarkable story. And again, it's one of these winners from this dislocation that a lot of people had a hard time and really, would have been very prescient here to see coming.
Well, do you know where my mind goes to? Straight to the trashy bottom line. Wonder what size the bonus is for the person that constructed the team. The team that constructed the bonus, not the person. It's always team.
I'm sure he's wondering.
Not when it comes to
bonus.
bonus.
They're wondering as well.
Okay, well, I suppose we'll find out. Danny, always great to see you. Danny Berger there with the inside track on the banking billions. Anne-Marie, let's have a snapshot of the markets as we go. Anna and Mark will take you through the next hour. We're in the green. Hurrah, as the Fed day begins.
Vietnamese people have shopped at wet markets or mom-pop stores for decades, and now e-commerce companies are trying to change this habit. Those including regional players like Shopee or Lazada or local startups Tiki have been building loyalty and trust by providing Vietnamese with services that are common in developed economies but very new to this country.
Mình chỉ cần ngồi ở một chỗ thôi và lên một cái trang web chẳng hạn thì mình có thể tìm được là rất nhiều cái mặt hàng ở trên đó. Thứ hai nữa là về cái tốc độ giao hàng thì bây giờ cũng đã nhanh hơn rất là nhiều rồi, thậm chí là có những cái mình có thể nhận sau 2 tiếng như Tiki Now chẳng hạn.
The epidemic has given digital retail a boost, with more Vietnamese buying everything from food to electronics online.
Còn một cái nữa đó là tại vì cũng đang dịch ấy, thế nên là nếu mà mua hàng online thì sẽ an toàn hơn cho tất cả mọi người bởi vì là mình sẽ không cần phải ra ngoài và tiếp xúc với nhiều người.
The country's e-commerce is expected to reach 29 billion in 4 years from 7 billion last year. The government is also encouraging this sector with target of online shopping to account for 10% of Vietnam's retail sales by 2025.
Curtain will rise again.
Broadway's returning June.
Have you bought tickets?
He's busted out.
You've got more time here. If you
Commodities are up.
Keep going.
To the
moon.
No.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash. $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Good morning. Welcome to Bloomberg Markets, the European Open. I'm Anna Edwards, live in London. Mark Cudmore, our Markets Live managing editor, joins me in Singapore to take us through all of the market action this hour. The cash trade is just less than an hour away. Here are your top headlines. England delays its full reopening. The Delta variant risks a hospitalisation surge as the vaccine rollout programme races to get second doses done. President Biden's visit to Europe continues with a EU-US summit amid reports of a much-awaited breakthrough on a 17...
Drop to markets in Asia, even though they're quiet, and that's because Chinese stocks were weaker on a number of concerns, most prominently a little bit disappointment from traders that the PBOC didn't inject more liquidity into the market today as some had hoped. And the other thing was the kind of worrying markets is that copper is quite weak again. And the commodities have been a little bit softer in the last couple of days. More it's been ags, but copper's ongoing weakness the last couple of weeks is making people a little bit concerned that some of the economic recovery, growth enthusiasm is coming out of the markets overall.
Right, let's get to some breaking news. We've got some UK unemployment numbers coming through, Mark, and we'll return to some of the themes that you mentioned just there, certainly around commodities. We've got the UK employment picture being painted for us a little bit here. The unemployment rate, 4.7%. The estimate was exactly that. The unemployment rate, 4.7%. The estimate was exactly that, 4.7%. So not far from where we had anticipated this number coming in. This is a 3-month rate, of course. Bloomberg Economics say they expect this number to peak at 5.5% by the year end. This is why, despite the fact that UK economy seems to be doing pretty well right now, there is some caution still from central banks, for example, from the Bank of England, because, of course, the furlough scheme is still playing that important role. And we heard an extension to the limited lockdown measures we still have in place. We had an extension to that, which is bad news for certain parts of the hospitality sector. We got that news just last night. So that's where we are with the unemployment story. Interesting to get some of the other numbers as well. Employees on the payroll rising 197,000. So more people in work. Jobless claims falling by 92,600 in the month of May. So some of this data for April, some of it for May. But all of those numbers seem to be moving in the right direction. I mean, the unemployment rate has not budged. That's pretty much as it was in the previous reading, but pretty much as it was in the estimate as well. So that's the picture for the UK unemployment story. As I say, though, questions around when that peaks. Let's have a look at where we are on these markets then. An hour away from the start of cash equities trading here in Europe, and let's take a look at the futures picture. We are seeing some movement on futures to the upside, up to 0.3% right now. In yesterday's session, we made some moves to the upside in Europe, and in the United States was a little bit more mixed, but futures do look positive. We'll keep an eye on copper prices, though. We'll return to the commodities theme in just a moment, and that's worth thinking about when it comes to the London market, certainly. But US stocks on the S&P closing at a new record, technology stocks lifting things there. European stocks, another new closing high, the 7th straight session in a row. So lots to talk about there when it comes to the strength of the European stock story. Let's come to the GMM with you, Mark, and tell us what you're seeing there in terms of the big picture. And perhaps give us your thoughts on these UK unemployment numbers, because the overall unemployment rate coming in pretty much as was anticipated. But there are some signs of other data very much moving in the right direction.
Yeah, absolutely, Anna. So first of all, in the GMM, it is a relatively quieter mixed day apart from commodities. Now, palm oil stands out again there at the top as that kind of bright red box at the top of the commodities column there for another steep decline. This is very much an Asia, local Malaysia-centric story, and it's unlikely to have the broader ramifications. But overall, commodities are a little bit weaker, both in the ags and the industrial metals space, and that's probably the broadest macro theme. As you can see, most of the other columns are mixed, and Chinese equities are the standout kind of weakness on the equity side. Now, you're talking about the US jobs data. That was the largest fall in UK jobless claims since November 1996, so almost 25 years. So I think that's another good sign that's generally positive there. What's interesting to note in terms of market reaction is that this data set this morning actually caused a very, very minuscule bump up in sterling. But it's in the context that yesterday's news that we were delaying the reopening didn't really cause sterling to kind of weaken much. So I think there's clearly a bias in the market there for sterling to strengthen here. You know, a small bit of positive news gets a little bit of a positive reaction. A bit of negative news is not causing sterling to weaken, and I think that's interesting.
Yeah, maybe the negatives all priced in then in terms of that delay. It had certainly been talked about for a very long time, primed for the upside then on sterling. Let me ask you about commodities. You drew our attention there to the palm oil picture that jumps out brightly in red. But in terms of read across into global markets, I wonder if the copper price is of interest. I was reading some of the commentary from the Markets Live team, in fact, talking about, yes, there might be short-term negatives, a short-term pullback, but maybe the longer-term, bigger picture story still just as intact as it was. Your thoughts on copper then this morning, Mark?
Yeah, I'm really going to rob the view of Jake Lloyd-Smith, who is the colleague on my team who's kind of written this kind of view, kind of compiling the various different views in the team, and this idea that, look, the short-term situation, the supply constraints that we were worried about aren't so tense in the short term, and I think that's why we've probably got more downside. We got a little bit carried away on the longer-term copper story. But that longer-term copper story is there. The fact is the world is both pumping up its kind of infrastructure demand, but also this world moving to a more kind of green environment means that we're going to have increased demand for copper. And that's going to stay there for the next couple of years. We've got a massive underlying, very strong demand story for copper, and the supply is just not going to come through fast enough. So I think that there's a general view that, you know, the next 50% move in copper is probably higher again. But as for the next 5% move, who knows? And I think the short-term fundamentals would say it might be to the downside.
Right, so that might be something to watch for on the downside and something to reflect on when it comes to the London market, perhaps, and the start of trading. Let me ask you about what's going on the Chinese equity markets coming back after a day of closure. In fact, a number of markets were closed in Asia, weren't they, yesterday? Coming back in a bit of a grump, down by 0.8%, and clearly, I mean, is this geopolitics? Does geopolitics stick to the Chinese equity market this way? Of course, we saw those concerns around the G7. They managed to get to a common view on China despite some of their differences. And again, at the NATO summit, some of their differences on display. Angela Merkel calling for something a little more nuanced, perhaps, suggesting there needs to be balance in the China view, whereas others, the sort of main message, I suppose, is that the military ambitions of China pose challenges. Does that stick to the Chinese stock market?
I think that's part of the story. So the Chinese equity weakness this morning surprised at first glance in terms of it was one of those market reactions where there wasn't one single narrative to describe it. There wasn't a dominant kind of negative. And Chinese stocks have been very weak on Friday. And the general theme was that, hey, they've got a little bit of catch-up. After they closed Friday, stocks have done okay since then, rest of the world. So there was a general idea that Chinese stocks should do okay today. And instead, they're the weak point again. And so that was a little bit surprising. But there were a number of slight negatives. So definitely the G7 stance and the NATO stance, the NATO stance being slightly more aggressive on that side kind of seemed to be a slight negative on the geopolitics. There was also a slight disappointment on the liquidity front in terms of the medium-term lending facility. There was a hope the PBOC would use the rollover to inject more liquidity into the market today, which they didn't do. So there was a bit of disappointment there. And there were some local domestic micro stories. There are some real estate concerns. There's still some kind of knock-on effect from the clampdown on safety and what that means for costs after the gas explosion on Sunday. So there are a number of kind of different elements here. None of them individually are enough to drive down the whole index, but together they kind of added up to 4 or 5 slightly marginally negative stories, and that's why we've got weakness in that market today.
Yeah, enough to take the edge off that Chinese market then. Remember, you can stay up to date with analysis and insight from Mark and his team. MLIV Go is the function to use on your Bloomberg to access the Markets Live blog. Coming up here on the European Market Open, we'll be back to that NATO theme. NATO talks tough on China, warning of its growing military might. We're in Brussels with the latest from President Biden's trip to Europe. Plus, funding the recovery. The EU kicks off with its biggest debt plan ever to raise 800 billion euros over the next 5 years. We speak exclusively to Klaus Regling, the Managing Director of the European Stability Mechanism. That is at 8:30 London time. If you have any questions of your own for our guests, please send them to us. IB plus TV Go is the function to use on your Bloomberg. This is Bloomberg.
valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Welcome back to the European Market Open. 11 minutes past 7 here in London, so 50 or so minutes to go until the start of the cash equity session. Just getting some breaking news coming through on the aviation sector. Emirates Airline, we've got a full year loss of 20.3 billion dirhams there, and we're also getting numbers for Emirates Group, of which the airline is part. The group full year loss 22.1 billion dirhams versus a profit of 1.7 billion a year ago. Nobody needs to explain too much the difficulty that anybody involved in the travel sector is having, and certainly we're seeing some smaller travel companies here in Europe also cautious on their outlook this morning, so that's also a theme we will keep an eye on. Let's bring in our next guest and focus on European stocks. Equities in Europe are popping like it's 1999 apparently, with the Stoxx 600 closing at an all-time high for 7 straight sessions. That's his best run in more than 20 years, helped by easing inflation concerns and optimism about the recovery. We're joined now by Sebastian Riedler, Head of European Equity Strategy at Bank of America. Sebastian, good to speak to you. So apparently it's like 1999. That's how many back-to-back new record highs we've seen for European equity markets. Too far, too fast, a little bit too much euphoria, or does all of that make sense?
I think it makes a lot of sense, and I like your comparison with 1999 because obviously, we all remember it as the tech bubble, but what was also going on, you had a tremendous acceleration in global growth, and that's what's happening at the moment. Over the past year, the euro area PMI, which is one of the best measures that we have for the euro area macro cycle, is up by 40 points. We really haven't seen it since the late 1990s, and equities reliably rally when growth momentum accelerates. So I do think the story is just playing out as you should expect it to.
Does that mean it's going to end like 1999? And if so, what's your kind of timing for when this disappointment will come?
That's a nice continuation of the story. The story in 2000 was a sharp deceleration in growth momentum. I think the underlying mechanism, the underlying logic is the same, which is the market is likely going to peak when the growth cycle peaks, and so that should be even more than inflation on top of investors' agenda. The question, this was a fantastic party. We've accelerated for a year. Everything that is cyclical has benefited. And now the question is, when is it going to peak? We think the most likely peak in the global macro cycle and the euro area macro cycle will be in the third quarter. But then the discontinuity and the this analogy with 1999 is we think there will be a soft deceleration growth because there really isn't any catalyst that forces you to decelerate forcefully. So yes, we think there will be a peak in the market in Q3, but then followed by a mild pullback as you effectively go from strong acceleration to mild deceleration.
Why mild deceleration and not some more serious pullback, Sebastian? Is that because of the different role that technology stocks played this time versus 1999? I mean, during the pandemic, technology stocks clearly very strong, but since we got the vaccines, the recovery maybe has been broader.
Yeah. Now, I'm really talking about the macro cycle. So we should focus on what has led us to accelerate and what potentially could lead to a sharp deceleration. So let's think about the last 2 peaks in the macro cycle. Obviously, in early 2020, you had a powerfully negative catalyst coming in, which was the pandemic. You had to close the economy, and that's really what generates a powerful deceleration. As far as we can see, there's no such factor around. Then think about 2018, the previous peak in the macro cycle when euro area PMIs were at similar levels as they are now, and you had a very unfavorable inventory cycle. So all the companies were drawing down their inventories. That leads to a sharp basically drop in production, and again the macro cycle peaked and rolled over. What we have now is still support for the euro area macro cycle from continued reopening. We have tremendous amounts of stimulus in the US, and very likely you will get an infrastructure bill at the end of the year further supporting growth. So all you're doing is you're running out of that powerful reopening fuel slowly, as opposed to some negative catalyst coming in from the outside.
Sebastian, thank you very much. Sebastian Riedler from Bank of America stays with us on the programme. Let's get a Bloomberg First Word News update. The top stories we're covering this morning. Here's Simone Foxman. Good morning, Simone.
Good morning, Anna. British Prime Minister Boris Johnson announced a month-long delay in lifting England's virus curbs as concerns over a rapid rise in COVID-19 cases persist. A particular concern is the increase in cases across the country of the highly contagious Delta variant. The government also said it will not extend financial support for businesses further, even despite the delay. In the United States, Senate GOP leader Mitch McConnell said it's highly unlikely that he'd let President Joe Biden fill a Supreme Court vacancy in 2024 if Republicans retake control of the chamber next year. There's been intense speculation about the possible retirement of the oldest justice on the court, Stephen Breyer, who usually sides with the court's liberal wing. Progressives have been urging him to step down before next year's midterm elections, which could flip control of Congress. China's rising military ambitions present NATO with challenges that must be addressed, the alliance said, marking a shift in its stance that could kindle a confrontation with Beijing. Secretary General Jens Stoltenberg heralded the speed at which the group stepped up to meet the threats. In response, China warned that it won't sit back in the face of any challenges. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
Simone, thanks very much. Simone Foxman there in Doha with your First Wave News update. Now, coming up on this programme, Wall Street's trading boom could be drawing to a close. More on that warning from Jamie Dimon. What did that do to bank stocks? We'll get the details. This is Bloomberg.
Last quarter is exceptional. This quarter is what I call more normal, where you can plug in your model and make it really simple. It's like something a little bit north of $6 billion, which is still pretty good, by the way, and probably better than we told you last time. But last time we said more like 2019. I forget what that number was, but plug in a number a little bit north of 6.
A little bit north of $6 billion. Jamie Dimon there speaking at a Morgan Stanley virtual conference, warning that the pandemic-era trading boom could be drawing to a close. Let's get more on this story then. Danny Berger joins us with the latest on this. Danny, good morning to you. So we heard from Jamie Dimon there and his comments. Did these comments come as a real surprise to Wall Street watchers?
Well, the shares did fall 2%, so, you know, some people had to kind of change their estimation. But look, banking executives have really been warning about this for really the past year when these numbers started cropping up, that this volatility in the markets wouldn't last. So that means that these sorts of profits wouldn't last either. Of course, that means it's not necessarily a surprise, but that 38% figure that Jamie Dimon warned about, that first quarter year-over-year drop just north of $6 billion, that is a figure that is worse than many had expected. So this is really a case of investors now having to sort of tweak their models of what earnings will look like. James Gorman of Morgan Stanley making a similar warning as well. But this is really the first time we're getting some concrete numbers put to the drop. So that's why we're seeing shares react negatively in the way that they did.
Good morning, Danny. On the Bloomberg terminal this morning, there was only one story that was more popular than these Dimon comments, and that was the banks again and the diverging approaches to their return to the office. Tell us what's going on there.
Yeah, so our colleague Sonali Basak was outside Goldman Sachs headquarters in New York yesterday, and even though it was raining, I was pretty jealous of her because Goldman Sachs, for the first time, welcomed back all their employees, and it was almost kind of like a festival atmosphere. They had live music, they had free food. Unclear whether or not they were playing DJ Soul's new hit. DJ Soul, of course, Solomon, the executive of Goldman Sachs, who did release a new single ahead of the reopening. But that contrasts, for example, if you head over to Canary Wharf here in London. We're not seeing that en masse welcome back. Most offices, JP Morgan, for example, Goldman Sachs, aren't looking at getting employees back until July, which of course reflects some of the caution coming from the UK government. But if you want to even go closer to Goldman Sachs West Street headquarters in New York, just down the street is Citigroup, and they're not welcoming employees back mostly until July. And even then, they're going to have more of a hybrid working model. So yes, we do have banks like Goldman Sachs welcoming people back, but it's not even by any imagination. It just really shows how banks are still trying to catch up and figure out what's the most sustainable model for getting employees back at this point.
Danny, thank you very much. Danny Berger with the latest on the banking sector. I wonder to what extent the CEO releasing a single is important in getting people back to the office. Maybe others will try. And let's talk now to Sebastian Redler from Bank of America. We won't ask you about releasing any singles, Sebastian, from anybody at Bank of America. But in terms of the banking sector, we had this warning then from Jamie Dimon, but your focus very much more on European equities. European bank stocks have done well to recover from recent lows. What is your trajectory from here, given what we've heard there from Jamie Dimon and the concerns that many had in the market about just how long the pandemic trading volatility would last?
The question always is, what is the main driver? Is it really all about volatility, or what typically do you need to do well? And for us, banks obviously are one of the best performing sectors over the past 6 months or so. And we think that will continue because there are three conditions under which they typically thrive. A, they want accelerating growth. And as we discussed earlier, we think there's still one last leg of the growth acceleration, especially in Europe, because you're only just starting to reopen. Secondly, they really like rising bond yields, and we think bond yields do not reflect the current strength in the macro environment, especially not if coupled with the rise in inflation and the buildup of underlying inflation pressures, especially in the US. And thirdly, they really like tightening credit spreads, i.e. a compression of the credit risk premium, and we think that has further to go with our credit strategists suggesting that credit spreads might even drop to an all-time low because of these buoyant macro conditions that we discussed earlier. And so for us, banks are at the sweet spot. But we also think that the macro cycle will peak in the third quarter, and then growth will go from acceleration to deceleration. We've already discussed it. So over the next 3 months, in the last leg of the growth acceleration, we think banks are one of the most attractive sectors.
Yeah. What happens if the Fed turns marginally hawkish, just enough to kind of steepen the yield curve significantly in the next couple of months, even as the ECB remains very dovish? What happens to European stocks in that scenario?
I think by far the most important driver of equities is growth momentum. Growth momentum will still be strong. The Fed will not change that. A second important driver is the currency. So some people argue, might not in the scenario that you described the dollar be strong because suddenly it gets yield support. I would argue against this. By far the most important driver of the dollar, because it's such a safe haven asset, is macro uncertainty. And macro uncertainty is just going one way. It's going down. Everybody is reopening. The kind of distortion from the pandemic are being removed. So we still expect the dollar to be weaker. And the only negative that would result from European stocks from that move is higher real bond yields, a higher discount rate, but very likely that would be offset by these other two factors that we've just described.
Sebastian, really interesting. Thank you very much for joining us. Sebastian Redler, head of European Equity Strategy at Bank of America, with the drivers for European stocks, growth momentum and FX amongst them. Coming up on this programme, NATO talks tough on China, warning of its growing military might. We're in Brussels next with the latest from President Biden's trip to Europe. He's been to the G7, attended that NATO meeting in Brussels. He hangs around for an EU summit and a meeting with President Putin. This is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Crypto is a nuanced issue, and it's possible the U.S. gets crypto wrong.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Welcome back to the European Market Open. Half an hour until the start of cash equities trading for this Tuesday morning. European equity market futures suggesting a little bit of upside at the start of the trading day, up by 3 or 0.4%. US futures also in the green this hour. Mark, let's think about what is on your mind this morning. And we've, of course, been talking about inflation of all varieties, CPI, PPI in various jurisdictions. Certainly, we talked a lot about the Chinese PPI number when that came through. We're going to get US PPI data coming through today. And it's really interesting. You drew my attention to the chart we're going to show now, which is what happens when you strip out all the supposedly volatile stuff in PPI figures. So take us through the details.
Yeah, you strip out all the volatility and you still get a very volatile number there today. I think the point is that we've got a big set of US data coming through today. Retail sales, industrial production, empire manufacturing, and what I'm focusing on is producer price inflation. It is a quiet session, but this data may get us moving. Now, if you look at this chart on your screen, you can see this is the producer price or inflation data, year-on-year prints going back over the last 10 years. Now, you can see that we've just hit 4.1% as the most recent number. That was for April. That was the last reading we got, and that's just way higher than anything else we've seen in the last 10 years. For context, when we last got an inflation scare of any sort, it was in 2011, when that's when we had the Arab Spring, we had food prices go crazy, the last commodity big surge. Well, then we saw producer price inflation top it at 3.1% year on year. So it was already 4.1% for the last month. Now today, where the forecast is for 4.8%, so another incredible surge again. And not only that, both the last two times we've had this print, it is surprised significantly on the upside yet again. So I think that this inflation story is unlike something that anyone in the last 20, 30 years has seen in terms of an inflation scare. This does not mean that it won't be transitory, but it does mean that most people who are saying they're experts on this issue, including myself, don't really have a clue, because we've not actually seen it in real terms. The last time we had an inflation scare like this was 1980, maybe even in the early 70s. So it's not something that we've actively traded through very recently.
OK, so if we get 4.8%, we might have to revisit the chart tomorrow, Mark, because it will look even more impressive. That story from the factory floor then in the United States. That's the US economy. Let's think about some US politics. And President Biden is still in Europe, set for his first summit with the EU today. Yesterday saw a meeting of NATO with the alliance warning of China's growing military power. Joining us now is our Brussels correspondent, Maria Tadeo. Maria, good morning. So what came out of that NATO meeting yesterday? Of course, China was a subject of the G7 as well, but they certainly picked up on it for the NATO meeting. Has the alliance been reinvigorated in its cooperation?
Well, you know, Anna, they would argue it has been. You know, that was a message that was repeated yesterday at the NATO headquarters time and time again, you know, to say this is an alliance that is strong, that is united. We stand by Article 5. That is, of course, if one member state gets attacked, everyone else would come to the rescue. And we feel that we have strengthened our relationship after this meeting and a more normal return to normalcy. That was the words of the Belgian Prime Minister, Alexander De Croo, when I was able to speak to him yesterday behind the scenes. Let's take a look.
We will not be divided. And that, I think, happened too many times over the last months, was that the United States and Europe were basically split apart. Right. That, I think, is not going to happen that easily anymore.
And that was the Belgian Prime Minister, Alexander De Croo, very much in line with the words that we heard from President Biden time and again, that protecting NATO is a sacred duty for the United States. Now, when you look at the communique that came out, and of course, two big countries in focus. One is China. NATO recognizing that China is a big economic power, but could also be a big military power, and that could be a risk to global security. And then again, Russia mentioned multiple times in that communique the risks of threats to Eastern European countries like Ukraine, Moldova, but also Poland, Lithuania coming up time and again. And of course, this is all happening one day before President Biden meets Vladimir Putin. There's a lot of focus as to what that meeting could actually turn out to be.
And ahead of the US-EU summit, the FT is reporting that the two sides are set to finally end the 17-year Boeing-Airbus dispute. What do we know on that front?
Well, look, I think this is a deal that is going to be very likely today. It's probably going to be announced today. It is becoming clear that the two sides want to settle this. This is a long-running saga for 17 years. The two sides accusing each other of using state money to prop up their aviation companies, and that will result in unfair competition. As you know, if tariffs were to kick in retaliation, it would be bad for European products. It would also be bad for American products. Now, what we understand is that that the two sides are working on a deal that would see limits to the amount of money that can be injected as state aid into the companies on a multi-annual basis. Now, to some extent also, Mark, it does make sense for this to happen today. You know, this is the final meeting of President Biden in Europe. Of course, he wants to show that the relationship between the U.S. and the European Union is really now back on track. And of course, what better way to do that with, you know, just to get this deal finally going after almost 20 years in the making.
Yeah, certainly been a long time coming. Maria, thanks very much. Maria, today with what we can expect from that EU-US summit set to take place today, a continuation of President Biden's visit then to Europe, and as we gear up for the meeting with Vladimir Putin, that takes place in Switzerland tomorrow. Let's get a Bloomberg Business Flash. Here's Simone Foxman.
Thanks, Anna. And Dunlop's hedge fund Third Point is said to have built a substantial position in Vivendi and is examining the French company's plan to sell a 10% stake in Universal Music to Bill Ackman's Blank Check company. Several of Vivendi's minority shareholders have voiced opposition to the deal, but sources say Third Point hasn't given its opinion on the transaction yet. Vivendi's spin-off of Universal Music goes to a shareholder vote on June 22nd. The much-awaited breakthrough needed to resolve the 17-year dispute over subsidies for Airbus and Boeing is set to be finalized Tuesday, just in time for Biden's first summit with the EU. This, according to the Financial Times. The deal could take the form of a multi-year accord on subsidy limits. Goldman Sachs welcomed all staff back to its Manhattan office on Monday. Meanwhile, Citigroup won't recall more of its staff until July. Morgan Stanley CEO James Gorman said their return to office policy will remain flexible until Labor Day, but he sent a tough message to New York-based employees, arguing that if they are comfortable dining out in the city, then they should feel comfortable working at the bank's headquarters.
When the vaccines weren't ubiquitous, we had to deal with that reality. Now they are. If you can go to a restaurant in New York City, you can come into the office, and we want you in the office. Now, our position here is that we want people to be vaccinated. Well over 90% of our employees who are in the offices are now vaccinated.
That's your Bloomberg Business Flash. Anna, Mark?
Simone, thanks very much. Simone Foxman in Doha. Now, US consumers' expectations for inflation over the medium term rose to an 8-year high in May. That's according to the Federal Reserve Bank of New York survey. KKR's Henry McVeigh told Bloomberg he believes prices will rise but won't run away.
The Fed wants to separate the bond buying from the ultimately from the rates, the short rates. And so what I think we'll see either sometime this summer or certainly by Jackson Hole is they start to talk about the bond buying being related to the tapering. And so they want to separate that that's pandemic related, but they're not going to shift their focus ultimately on the average inflation targeting, the AIT that they rolled out a year ago. They're fully committed to that. That is a more accommodative monetary policy, and it ultimately means that inflation will run hotter than in the past. Remember, the Fed's got to generate 50 basis points per year because of technological change and all the transparency that it creates. And so I do think we're going to have higher inflation, but I don't think it's going to run away the way some people do. And to that end, I think bond yields will move higher, but not to unattractive levels.
Sorry, can we be specific here, Henry? What does higher mean? Are we talking 3%, 4%? What number should we be penciling in?
Yeah, ultimately, KKR, we think rates are going to back up to about 2.5%. When you look at the past couple of recoveries, bond yields have actually gone up about 160 basis points from the bottom during the first parts of the recovery. We've only moved up about 100, and so there's actually more wiggle room that could get you north of 2. That's the bull case on why rates are going to go up. Let me give you the offset. One is transitory inflation is probably peaking right now in the bond market. Even when we got the huge CPI print last week, it started to rally. The second thing, ultimately, I believe is I think there's a huge savings is supposed to equal investment. I don't think that's the case. I think there's so much money in the system that savings ultimately will be above investment, and the yearn for yield is going to remain huge. I mean, we own over 200 companies globally. We own an insurance company, and ultimately, what central banks have done is they've taken away from savers, and that has created pent-up demand for yield. And you see that in the way that we're ultimately starting to see clients need income in their portfolios.
So there's going to be huge longer-term implications of that, because even if you get to rates at 2.25, that's still so low. So you have higher inflation, growth that's going gangbusters, more savings, and lower rates. That would imply that investors are going to have to go out the risk curve. What's the implication?
Well, I think investors are out the risk curve right now.
But even more so, maybe.
Well, ultimately, I think it's going to be this combination where what happens when that unfolds is that you'll see some of the more speculative parts of the growth market come under pressure. What's going to win is going to be cash flow and pricing power. We're in an environment right now where the input costs measured by the PPI are rising faster than the consumer price index or the output costs. That creates a margin squeeze. We saw this when China built out its fixed investment two decades ago. Companies weren't ready for that, and that's what's going to happen right now. Remember, 86% of the companies in the S&P next year are supposed to have rising margin. It's not going to happen. So there's going to be a focus on reflation investments. There's going to be a focus on pricing power. And ultimately, when you think about what we're doing across private equity and certainly in our real assets portfolio, that's where we're driving our balance sheet, and that's where we're forming capital in partnership with our limited partners.
That was the KKR head of global macro and asset allocation, Henry McVeigh, speaking to our colleagues here at Bloomberg. Coming up on this program then, England delays its reopening as infections mount. The Delta variant now accounts for 90% of UK cases. More details on what we heard from the Prime Minister and the impact on the economy next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European market open. 16 minutes until the start of Tuesday's cash equity session, and futures do suggest a little bit of upside at the start of our trading day. Now, England's Freedom Day, as it has been dubbed, has been delayed. As expected, Boris Johnson yesterday announced that he was pushing back lifting the final virus curbs by a month. That's amid concerns over a rapid rise in COVID cases as the highly contagious Delta variant spreads. But the Prime Minister reassured weary Britons that an end is in sight.
On the evidence
that I can see right now. I'm confident that we will not need more than 4 weeks, and we won't need to go beyond July the 19th. It's unmistakably clear the vaccines are working, and the sheer scale of the vaccine rollout has made our position incomparably better than in previous waves.
Bloomberg's UK economy reporter Lizzie Burden joins us now. Lizzie, good morning. Lots of things to pick up with you then, and we'll certainly talk about the extension of the lockdown measures, such as they are. We have, of course, seen a lot of opening up of the UK economy. But let's start with some of the data we've had this morning then. UK jobs data has just been released. What was the story there? A lot of the data seems to be moving in the right direction.
Yeah, so in May, the UK added jobs. Vacancies climbed 16%. It's what we expected. Remember, in May, this is when restaurants and cinemas reopened, so that led to a surge in demand for jobs. Could be a different story in June, as you say, about the reopening being delayed.
Yeah, Mark.
So good morning. Obviously, this extension is devastating for certain sectors and certain individuals. But what does it mean for the economy generally?
Well, it's obviously going to be a devastating blow for certain sectors, as you say. The main hit is going to be the extension of social distancing rules. That's going to be bad for hospitality, for example. Earnings are going to be severely curtailed there. And yet, despite the extension of the lockdown, government support measures aren't expected to be extended. The example is still expected to be tapered as planned. And that's despite the warnings of hospitality bosses that hundreds of thousands more jobs could be lost. But we have had recently reports from various sectors that there are labour shortages, and so the government could be allowing the economy to restructure whilst at the same time saving cost of furlough. But while it's bad for hospitality, tourism, travel, entertainment, the arts, overall the economic impact could be quite limited. Economists have been expecting this delay of 2 to 4 weeks, and we have seen mobility and confidence actually getting back to normal as restrictions carry on.
We have a lot to talk about then when it comes to the UK. We've had the labour data, and of course the part of that narrative has been the lockdown measures, and now we know how long some of that will last for certain sectors in hospitality. We have other threads to talk about as well, Lizzie, and one of those is trade, because post-Brexit the UK trying to do lots of trade deals, and it seems as if we're moving towards the first trade deal that's been entirely created, if you like, post-Brexit, rather than just being a replacement of an EU trade deal. Tell us more about that.
Very exciting. So we could have the broad terms of a UK-Australia trade deal out today. It's expected to cut tariffs on Scotch whisky, clothing, cars, also agricultural products, and that's going to be really controversial with British farmers. Politically, a big win for the UK, especially in the post-Brexit Global Britain project, as you say, but economically, not so much. It's only expected to add 0.02% to GDP over 15 years.
Yeah, very exciting, you say, but then, yeah, we're going into the details, and you see the truth about the size and scope that these trade deals can represent or not. Thanks very much, Lizzie. Bloomberg's UK economy reporter Lizzie Burden with us with the latest on the UK economy. And for more on the Delta variant, make sure to catch our Q&A with our pharma analyst Sam Fazeli. That's at 3 p.m. at London time today on TLIV, that is on the terminal. And let me also tell you about some breaking news across the Bloomberg just now. We've got the EU and the US reaching a deal to resolve the Boeing-Airbus trade dispute. This was something that was reported over in other media overnight, and certainly we were talking about this with our colleague Maria Tadeo, who is on the ground. We heard from her about the fact that this has been a very long time in the making. This breakthrough agreement is going to be finalised today, Tuesday, as the US President Joe Biden continues his trip to Europe and makes his first EU-US summit visit. That meeting taking place in Brussels. We had heard, of course, that the deal could still fall apart, likely to take the form of a multi-year accord on subsidy limits. But it does seem as if we have some more solidity to this now, because our colleagues in Bloomberg News now reporting this fairly factually. The EU and US reach a deal to resolve the Boeing-Airbus trade disputes. Let's take a look at some of the things that we're watching out for then today. At 10 a.m. UK time, we will have Euro area trade balance figures. At 1:15 p.m, Bank of England Governor Andrew Bailey is due to speak at the Citi UK annual conference. I think the City Minister will be speaking this morning as well. This afternoon, we will have data from the US, including PPI and retail sales. And keep an eye on the EU-US summit in Brussels. We just heard about that latest news that is expected, no doubt, to be announced there around Boeing and Airbus. President Joe Biden is in attendance. Plus, the UK Prime Minister Boris Johnson will hold a bilateral meeting with his Australian counterpart, Scott Morrison. They had dinner, and it seems as if a trade deal could be in the offing there. And Oracle Corporation is expected to report earnings for the first fiscal quarter. That sometimes has some read across into the likes of SAP here in Europe. Coming up then on this programme, we'll look at some of the stocks to watch, including H&M. That's as the Swedish retailer rebounds as pandemic restrictions ease. That conversation next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Welcome back to the European Market Open. 7:53, so 7 minutes to go until the start of European equity trading for this Tuesday morning. Let's get the stocks we're watching for at the open. Danny Berger has a breakdown. Danny.
And H&M out with some numbers for their earnings so far this quarter. And yes, we did see a rebound in sales in the second quarter, but it fell short of estimates. At the same time, we still have a lot of stores closed, and I think that slightly lighter picture on sales is why, for the most part, we're seeing a lot of people call these shares lower at the open. But one company that's due to move higher is Equinor, boosting its payout to shareholders by about 20%. Also going to start a buyback program of about $1.2 billion. So those two things combined surely will mean we see a pretty sizable share increase. They're also putting out new goals for reducing carbon emissions, really just reflecting the general environment around oil and gas companies to meet these demands of sustainability from investors. Lufthansa also out today with some new targets for margins. They're going to be cutting costs, be it reducing office space, trimming staff, reducing marketing costs. So that's going to be about 3.5 billion euros they plan to save annually. They're up higher on TradeGate. They're also going to try to renegotiate some contracts with suppliers. So Airbus, Boeing possibly on the move. And of course, those two also might be affected by the US and the EU agreeing to end their 17-year dispute over some of the subsidies of these companies.
Yep, Danny, thanks very much. Our markets reporter, Danny Berger. We will certainly watch for movement in Airbus. And Mark, there's a quietness to today through the Asia session, perhaps. A bit of movement in commodities, though. We'll keep an eye on that as we get towards the London Open.
Yeah, there is a quietness, but actually the European session seems to be coming in to be slightly more optimistic than Asia. It's a little bit of a repeat of yesterday, where commodities were a little bit weak, equities in Asia weren't very exciting, and then European traders came in and kind of bought us up a little bit around this time yesterday, around the Open. Nothing crazy, but just a little bit more positivity. So I think it's going to be an okay session until we get the US data, which is probably the big trigger for some potential moves later.
Absolutely. We'll keep an eye out for that then. European stocks closing at new highs for 7 straight sessions. That happened last in 1999. But as you pointed out earlier on, Mark, not the same percentage gains that we're seeing, very much less so this time around than 1999. Mark, thanks very much for spending the past hour with us. I'll be back with the European market open, as Mark suggests. Futures pointing to the upside. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Welcome back to the European market open. A minute to go until the start of cash equities trading. Here are your headlines. England delays its full reopening. The Delta variant risks a hospitalization surge as the vaccine rollout program races to get second doses done. President Biden's visit to Europe continues with an EU-US summit amid reports of a much-awaited breakthrough on a 17-year dispute over Airbus and Boeing subsidies. And JP Morgan's Jamie Dimon says the trading boom could be coming to an end, signaling a bigger than expected drop in revenue for the largest US bank. Let's have a look at the futures then. And in fact, we've got more than just reports now in terms of that Airbus story. So perhaps we'll see a little bit of upside for Airbus if there's still anything in it after 20 or so years talking about subsidies to the aviation manufacturing sector. Airbus and Boeing have been at loggerheads over such things, tax breaks, subsidies and the like, allegations and counter-allegation flying across the Atlantic for 2 decades. It seems as if, according to our reporting at least, that we will see some resolution of that particular conflict at the EU-US summit that President Biden is attending in Brussels today. So we'll look for an opening price on Airbus with that in mind. This is the broader picture we have, though, for European equity markets as we open up this morning, up by 0.3% on the FTSE 100. Keeping an eye on the mining stocks, that was a weak point for yesterday's session. And whilst we saw gains broadly for European equity markets at this time yesterday, it certainly was the basic resources sector that was a bit of a laggard. Maybe we'll see something similar today. I see the CAC 40 just opening up by 0.4%, and one of the things pushing it higher could be the Airbus price. There we are, up by just over 1% on Airbus this morning. It is a very large stock, of course, so take quite a lot to move it around. But we have had these headlines about resolution of that trade standoff with around the relationship between Airbus and Boeing, or rather the level of support given to each of those businesses by the European and US governments, respectively. And so that is pushing the Airbus share price just a little bit higher, up by 0.9% this hour. So European equity markets opening broadly to the upside. That's as investors consider this week's key meeting of the Federal Reserve. Stocks have been mixed in Asia today, gaining in Japan but lower in China. China, though, playing a little bit of catch-up after being closed yesterday. So the broader picture seems to be modest gains across global equity markets. Let's talk now to Vincent Juvens, global market strategist at JP Morgan Asset Management, who joins us this morning. Vincent, very nice to speak to you. In fact, we've seen a very strong run for European stocks. I wonder how much further to run you think they have. We saw 7 days in a row of new closing highs for European stocks. That is something we haven't seen since 1999. The percentage is very different. The percentage back then was much higher in terms of gains than it is now. But certainly the number of days in a row is quite similar. So do you think that makes sense? Are we right to be seeing such strength in European stocks right now?
Yes, I do. And you alluded to a couple of themes which are important in your introduction. Airbus, cyclicals, trade recovery, easing of trade tension, all elements which are obviously very supportive for European stock as a whole. So clearly we remain optimistic on European stock at JP Morgan Asset Management. When you look at the positioning of our multi-asset portfolio, we remain long European equities. This said, being positive on equity market, being positive on European equity market doesn't mean that we expect on top of the 10-15% already recorded year to date in terms of performance, that market will reproduce, let's say, the same level of performance in the month to come. So we need maybe to lower a bit or return expectation going forward, given the valuation we have already seen. You alluded to, obviously, to the comment of Jamie Dimon about trading revenues. We're probably going to see on market plateauing at some point globally, including in Europe. But Europe obviously will benefit from additional support in the coming weeks and months. Vaccination campaign are really speeding up in Europe. Europe is reopening. So on top of foreign and external demand, you will see obviously a very strong momentum locally, which will support earnings and economic activity.
And Vincent, how much is the low yield environment helping us to achieve that strength in European stocks then? You say it has a little bit further to run. Does it depend on what happens with the US 10-year yield, currently at 1.48%? Does it depend on what happens with bond yields, which the ECB seems keen to keep under control?
So clearly the interest rate environment has supported Europe. We have seen this rotation from growth into value, from, let's say, into cyclicals, and Europe has benefited from it. Clearly, European banking sector has been one of the main driver of the recovery of equity market in Europe. And we expect, indeed, interest rate in the US to continue to grind higher. I guess everyone is looking at the 2% level by year end. There should be some contagion in Europe, but we've heard from the ECB that they're definitely not in a rush to stop their easing program, stop their quantitative easing. So I would expect interest rate in Europe to remain well anchored. But Indeed, it has been supportive for European cyclicals. For European investor, the fact that ECB is not moving means a lot. You may not be aware of it, but in Europe, for many banks are now obliged to apply negative rates on the household deposit, something we haven't seen over the last couple of years. So the negative interest rate becomes a reality for more and more savers and investors here on the continent, forcing them to look at alternative on financial market. Clearly, fixed income at the moment, given the upward pressure on rate, is not a real option. So you still see a lot of appetite for equity market in Europe. So this re-risking of European household is also one of the elements which supports European equities at the moment.
That's really interesting, that re-risking then of European households, pushing people into equities. I know there had been some debate previously about whether negative rates does that or whether it makes them save more. So that's an interesting perspective. Let me get your thoughts on the inflation story and the supply side of the inflation story that seems to be under stress, under disruption in many parts of the world. How long do you think before we start to see some normalization of these supply side difficulties that have pushed up PPI prices in various parts of the world? I ask this because I think that the rationale is supposed to be that as more people in the West get vaccinated, they spend or they go back to spending more on services and don't spend quite so much on stuff, and therefore we get some kind of respite on the supply disruption side of things. Is that what you're expecting to see? What kind of time horizon, Vincent?
Yeah, at JP Morgan Asset Management, we expect exactly the same. So the inflation surge that we have seen recently, we consider it as transitory. We do expect that as of start of next year, maybe at the end of the first quarter, next year, things should normalize. Obviously, discussing supply side constraint, it's a vast topic because it goes from stuff as you describe it to semiconductor, and obviously each area has its own specificities. But indeed, I would expect European consumer, like Americans, like Chinese consumer, to shift from goods to services going forward, which should ease tension on supply side constraint that we have seen. In addition, I would say logistical routes are obviously improving again. We have seen tentative sign of, let's say, improvement in terms of indeed export from China, freight costs and so on, which are going down here and there. So I'm not too concerned about it. In the short term, it is clear it is an investment theme, and we need to go along with it. This means that from our standpoint, being short duration, long, let's say, assets which are well protected against inflation and stock stands out in this context. Over the mid and long term, we are not overly concerned about inflation. And somehow China maybe give us an idea of what to expect going forward. It's true that PPI remain elevated in China, but CPI is well contained. That's something we may see in a developed market as well. I have maybe a bit more question in the US, which is turbocharged with fiscal stimulus at the moment. In Europe, the story is a bit different. So to cut a long story short, we are not overly concerned about inflation, but the investor should rather indeed take, let's say, good hedge in the short term, and stocks stands out in this respect.
Vincent, thank you very much. Yeah, drawing our attention there to the lack of the link between the PPI and CPI numbers then in China. Thanks very much, Vincent Juvens from JP Morgan Asset Management. Stay with us, Vincent. We'll be back to you shortly. Coming up on this programme, slipping from record highs, European renewable stocks have fallen around 27% since January. We discuss the move away from growth and defensive equities and talk about emissions trading schemes across Europe and what they can deliver. That's next. This is Bloomberg.